Welcome to the webinar, Mass Customization versus Mass Production, Thoughts on the Future of the Investment Management Industry. We're featuring Lionel Martellini, who is a professor of finance at the EDHEC Business School and also a director of the EDHEC Risk Institute. My name is Dave Kramer, and I'm a director within Yale's executive programs. You may be wondering, why is the Yale staff introducing an EDHEC professor? The reason is that for the last 5 years, Yale has partnered with the EDHEC Risk Institute and delivered an advanced risk and investment management program. This program is targeted for individuals like yourselves, portfolio managers, endowment managers, fund managers, and also managers of ultra high wealth individuals. This seminar, though, will cover that at the end of the seminar, or we'll cover that at the end of the webinar. The focus today is on the future of the investment management industry. In a moment, I'll introduce Lionel. However, before I do that, I want to explain your role. Your role is to listen and engage. You're given the opportunity to ask questions using the technology. At the bottom of your screen, there's a Q&A button. Please press that and type in your questions. You can direct them either to me personally, in terms of a private message, or make them public so everyone sees them. We suggest public because we want a good discourse to go on. I will then direct them to Lionel at different points of the conversation as he's doing the presentation. There'll be different break points. But please engage. If you're having a technical problem, please use the chat button at the bottom of your screen and type in any kind of technical issue you may be having. It could be sound, it could be feedback, and we'll direct you as far as how to potentially clear that up. Now on to Lionel Martellini. As I said before, he's professor of finance at EDHEC Business School and the director of the EDHEC Risk Institute. Lionel holds a master's degree in business administration, economics, statistics, and mathematics, as well as a PhD in finance from the Haas School of Business, University of California, Berkeley. He's a bit of a renaissance man. He also is an exceptional skier and a triathlete. He also earned an additional PhD in astrophysics at the University of Côte d'Azur. More relevant to you, though, he's a former member of the faculty at the Marshall School of Business, the University of Southern California. Has been a visiting fellow at the Operations Research and Financial Engineering Institute at the department within Princeton University. Lionel is a member of the editorial board at several journals, including the Journal of Portfolio Management, the Journal of Alternative Investments, and the Journal of Retirement. He conducts active research on a broad range of topics, including long-term asset allocation decisions, equity and fixed income portfolio construction, risk management, and derivative valuation. His work has been published in leading academic journals and has been featured in major European and global dailies such as the Financial Times and the Wall Street Journal. He has co-authored reference textbooks on text topics related to alternative investment strategies and fixed income securities. Please welcome Professor Lionel Martellini. Lionel?
Thanks, Dave, for your introduction, and well, good morning or evening, everyone, depending on where you currently are. Well, it's a pleasure for me to spend the last hour or so with you, and I'm going to propose that I will share a few thoughts on the future of the investment management industry. Well, I think, as Dave said, it would be extremely useful and actually delightful if we can make this a conversation given the technological means that we are using. In other words, if you can engage and provide feedback in terms of questions and comments. What I would like to talk to you about today is this industrial revolution, which is taking place as we speak in investment management, and which makes investment management particularly exciting in these days. So I'm going to talk about the industrial revolution in investment management as my introduction. And then I will be arguing that there are two particularly important or relevant aspects of the industrial revolution. One is the mass production of smart factor indices, which is of high relevance to many different segments of the investment management world. And then I'm going to talk about the mass customization of investment solutions, whether we call them liability-driven or goal-based investment solutions. And I'll have a few final thoughts as a conclusion on the last remaining challenge, which is mass distribution of these mass customized investment solution based on mass produced building blocks, if you will. Okay, talking about revolution. There are different ways to talk about and to think about the revolution which is happening as we speak, but probably a fairly simple and meaningful way is to think about the move away from investment products towards investment solutions. And obviously, such a move is highly welcome. So what we're seeing is, after many decades of relative inertia, where investment managers and asset owners have been looking at different methodologies to try and improve the way portfolios are managed, there's a new paradigm emerging. And this new paradigm is actually centered around investors' problem as a starting point, which is the reason why we like to think about this new paradigm as a welfare-improving, cost-efficient, investor-centric value proposal for investors. So let's forget about one-size-fits-all products, and let's move on to dedicated, customized, or in some cases, mass customized, at least, investment solutions. Now, this industrial revolution, as all industrial revolution, is based on advances on two fronts. The first front is mass production, and the second front is mass customization. So these are the two topics that I would like to discuss today. On the one hand, the mass production of cost and risk efficient smart factor indices. And in a moment, I'll explain what I mean by smart factor indices. Kind of a buzzy word, but has actually a substantial, academically grounded, meaningful content. And then I will moving on the mass customization of meaningful goal-based investment solutions, starting with these building blocks. Now, interestingly, not only is our industry evolving extremely fast, and the last 5 years have seen probably unprecedented kind of pace of change in terms of innovation in our industry, which has been kind of fascinating to watch from the outside. But it is the case that all of these changes are actually taking place in a world or in an environment which itself is kind of moving as well. And there are two other profound revolutions that actually impact the investment industry simply because they impact the entire world. And these other profound revolutions are the digital revolution, we can call it the digital disruption in some case, and the environmental revolution, both of which also have extremely meaningful, substantial impact on investment management. Well, so to make a long story short, the investment industry is going through massive changes in a context or in an environment which is itself subject to massive changes. So that makes it a particularly exciting moment for us, maybe to take a step back and start thinking carefully about what's going on and try and think about, you know, what's the perspective? Where are we heading? You know, where's the value added in all of those changes? So that's kind of what I would invite you to do with me today. Well, okay, so let me start with mass production, the rise of smart factor investing. Okay, the first concept, which is very important, is the concept of factor investing. It is obviously not a new concept to talk about mass production in investment management. If you think about the mutual fund industry, by its very definition, it's all about mass production of portfolios that actually make sense to different people. So we've already had mass production of portfolios, call them mutual funds. Then eventually mutual fund turns into securities. I mean ETF, exchange traded funds. So whatever the format, we already have access to a number of building blocks that are mass produced. So what exactly is new Why are we talking about mass production as something which is happening as we speak? Well, what's happening as we speak is a move away from asset classes towards factors. So what's really important in terms of mass production is the rise of factor investing. Now, when you think about the concept of factor investing, the concept in itself is actually pretty simple and meaningful, right? So I'm just looking at this quote from one of our colleagues, Andrew Yang, and Professor Andrew Yang talks about factors. You know, factors are to assets what nutrients are to food. And when we are told that we should be eating right, well, we should actually looking through food labels to try and understand what exactly is to be found within these different meals that we are being offered, right? Well, that's exactly the same phenomenon taking place. Investing right means looking for asset class labels, which sometimes are very ad hoc and arbitrary, and looking at the underlying risk factors. So what matters when we invest in securities is not the fact that we invest in securities as such. What matters is the securities have factor exposures. And when holding a portfolio of securities, we are actually implicitly holding a portfolio of factor exposures. And more often than not, that portfolio factor exposure that we're holding is implicit, and there's value in trying to make it explicit. That's kind of what we mean in terms of factor investing. If only because we want to avoid, for example, a seemingly well-diversified portfolio in terms of asset classes to actually hide an extremely heavily concentrated portfolio in terms of factor exposures. And unless you pay attention to what kind of factors explain or drive the risk and returns of all of those asset classes, that's something that can happen as well. Now, if you're thinking about factor investing, well, you know, the concept is very simple, but of course, implementation is much more complex, as usual. Well, I think it's important to distinguish between different segments of the markets. In equity markets, as we will see, factor investing is pretty mature as we speak. And for the next few minutes, I will have a focus on equity markets, if only simply because it's an important, obviously, segment of the market, but also because it's a part of the market where the concept is now heavily operational. We know how it works, and we can make it work. What are the new frontiers? Well, the new frontier is clearly fixed income markets, harvesting risk premia in treasury bond markets and corporate bond markets. There's a lot of things that are happening. Then there's also a good case to be made that in things like, you know, commodities or maybe real estate, factors are also very important. And we want to think about the meaningfulness of factor investing in these real asset markets. Of course, above and beyond looking at the factors that are meaningful within each asset class, we should also try and understand the factors that are meaningful across asset classes as well. Okay? And these are all kinds of questions that, you know, we typically tend to spend a little bit of time on during our seminars when we meet, you know, in New Haven on Yale campus and we start discussing, you know, factor investing in a multi-asset context. And I'll come back to that in a moment. What I would like to do now is just say a few words about factor investing in equity markets and why it actually makes sense. Well, probably the best place to get started is to look at cap-weighted equity benchmarks and try and think about why they're not necessarily a good starting point and why we should, you know, turn the focus potentially away from cap-weighted indices towards smart factor indices. Okay, cap-weighted indices are typically used by portfolio managers, asset owners, and they are used as benchmarks both for active and passive portfolio management. The problem, though, is they actually suffer from two problems. Not only one problem, there are actually two problems that explains that eventually the risk-adjusted performance that you can expect from holding a cap-weighted benchmark is not nearly as good as what you deserve. Okay, here is the problem number one. Cap-weighted indices typically are poorly diversified. There's a strong concentration in the largest cap stocks that results in an excess of specific risk, which is unrewarded. So you get too much uncompensated risk, which means that when you look at the total risk of your portfolio, well, the reward per unit of risk is not as good as what it should be. And there have been, across regions and in the past, extreme examples. I mean, the typically extreme example is Nokia in Finland, where Nokia made up for more than 50% of the Finnish stock market. So if you were a pension plan holding the Finnish stock market, well, you are essentially holding Nokia. Well, there are other examples in Switzerland, but also in the United States, where we see that a few companies, let's say Apple, make it for a very large fraction of a given index. And as a result of that, the index is not exactly well diversified. There's a lot of uncompensated risk in the index. Okay, that's one problem. We would like to get rid of that unrewarded risk as much as possible. Well, there's actually a second problem, which is perhaps even more acute. And here is the second problem. When we're holding an index, whether we know it or not, and whether we like it or not, we are actually holding an implicit set of factor exposures. And as we said before, there's always value in looking through the index or through the securities and trying to understand the kind of factor exposure that you're holding. Well, let me give you an example. Cap-weighted indices have a bias towards growth stocks compared to value stocks. Well, simply because growth stocks are more expensive, their market caps are higher, and as a result of that, in a market cap weighted index, they get a higher share. In the same way, cap-weighted indices, by construction, have a bias towards larger cap stocks, as opposed to mid-cap stocks, or even small-cap stocks, if the universe you're looking at is a comprehensive universe that go from small to mid to large. Now, here is the problem. When you're holding a cap-weighted index, the point I'm making is you're holding an exposure to growth, and you're holding an exposure to large cap stocks. Now, here is the problem. Long-term academic research and also industry findings have documented that there's a premium associated with holding the exact opposite factor exposure. So value premium from Pharma French 92, we know that value stocks outperform growth stocks. In the same way, we know that small cap stocks actually outperform large cap stocks. So what we're saying is, while holding a cap-weighted index, one is actually, even without knowing it, one is actually paying, as opposed to cashing in, the value premium and the size premium. Well, if you're happy about it, if you're explicitly conscious that you want to hold a growth bias, a large cap bias, well then, so be it. But most investors would end up holding through these cap-weighted indices a set of factor exposure that may or generally may not be extremely efficient.
Lionel, I have the first question, all right? And the question is a little obtuse here, but it says, momentum factor exposure as well with market cap indices. So I think what they're saying or asking is, isn't there also a momentum factor within these indices? Another question maybe, part of that may be, is how do I assess or how do I determine what factors are in my indices when I hold in that portfolio?
That is a great question. If you look at value and size, you're wrong. You get the exposure in the wrong way. If you think about the momentum factor or momentum premium is based on the excess performance of past winners compared to past losers. Well, in this case, we get lucky with cap-weighted indices because by construction, the cap-weighted index will give a bigger weight to a stock that is a past winner because by definition of it being the past winner, stock price goes up and therefore market cap goes up, therefore makes up a bigger fraction of my portfolio. So what we're saying is it's a pure, unless you do something about it, you're not controlling the factor exposure that you're having. Some of them you may like, some of them you may not like. Now, if I like past winners, then I might be happy to hold the cap-weighted index, except that the cap-weighted index will lead me to hold the past winners and overweigh them compared to the past losers. well, wait a minute. If I like the past winners, and if I want to get after the momentum premium, I don't want to underweight the past losers. I just want them out of my portfolio. Underweighting them with a cap weighting scheme, that's not going to make me happy. If the past losers are going to be losers again because of momentum, I want them out of my portfolio. So clearly we understand that indeed having factor exposure being implicitly set by the kind of portfolio that I'm holding is not a healthy way to go. So back to your question, what we should be doing is we should be very extremely careful when looking at an index to exactly measure the kind of factor exposures that are in the index. And there are numbers of ways to do that, and we can do it using the holding-based analysis or using the return-based analysis, looking only at returns. So I don't have time to get into the technical details about how to doing it, but there are at least two ways to doing it, and there's always value in doing this, so that at least we make those implicit weights explicit. So let's think about them this way. Cap-weighted indices, using them as, they're fine as indices, but using them as benchmarks, well, let's call it a lazy option. Well, that's what the market does on aggregate, obviously, because it's the index that represents the portfolio that the market is holding on aggregate. But who says that this is an efficient way to harvest this premium? Okay, well, here is the question now. If we don't want to be lazy when harvesting risk premium, which I call lazy beta, and if we want to be more efficient, let me call it smart for the lack of a better term. And smart has become the accepted word, even though it doesn't, exactly mean something extremely deep. But smart is the accepted word now to talk about an efficient way to harvest a given risk premium. How do I do this? Well, I can think about better weighting schemes, and people have been looking at equally weighted portfolios as opposed to cap weighted. People have been looking at global minimum variance portfolios, call them GMV here. People have been looking at ERC, equal risk contribution portfolios, also known as risk parity portfolios. People have been looking at fundamentally weighted portfolios, where the stocks are weighted according to some fundamental measure of company size. And here is the problem. Any one of these portfolios might be better in some sense than the cap-weighted portfolio, but all of them, they also come with their factor biases. So think about equally weighted. Equally weighted is better than cap-weighted in terms of exposure to value and size. It doesn't have the bias towards the growth stocks and the large cap stocks. It actually emphasizes more the value stocks and the smaller cap stocks compared to the cap-weighted index. So it sounds like we are doing well in terms of harvesting the size premium and the value premium. But again, going back to your example of momentum, well, this guy got it wrong because equally weighted, we sell the winners and we buy losers. So now we're paying the momentum premium. So we're cashing in the value premium and the size premium, but we are paying the momentum premium. I don't like that. I would like to cash in the momentum premium as well as the value premium and the size premium if I care for this premium, right? So what is the best way, or what is the new way to think about the problem? Well, it's actually extremely simple. That's why we call factor indices, and we call them smart, to think about the way to make them well diversified. Here is what we mean by a smart factor index. And let me use this quote again by Eugene Fama, who's a Nobel Prize winner in economics for his work on efficient markets and other things. But here is the quote, and the quote is pretty simple and compelling. What we're discussing is actually very simple. All we really say in finance is hold a diversified portfolio along whatever tilt that you choose. So if somebody asks the question, I care for momentum, I would like to get a piece of the momentum premium, what should you do? Should you go with a cap-weighted index that overweights past winners but still allocates to past losers? No, you certainly don't want to do that. What you should be doing first is selecting the past winners. Let's say you split the universe in two buckets and you take out the past losers. You don't want to allocate anything to them, zero. And you just look at the past winners. Well, let's call that a factor index. Now, how do you weight the stocks in that factor index? Well, you could use cap weighting to use the stocks, to weight the stocks that you have selected, in this case, the past winners. The problem, though, if you do that, is then you're going to have a poorly diversified portfolio. Remember shortcoming number one. The portfolio is going to be heavily concentrated in too few stocks. And there will be a lot of unrewarded risk in your portfolio. So what you should be doing instead, well, you should be instead using some of these smarter weighting schemes, let's call them equal weights or equal or risk parity weights or minimum variance weights or max diversification weights, whichever you like. And each one of them will do a pretty good job at diversifying away unrewarded risk from a portfolio of factor tilted securities, namely in this case, the past winners. So let me give you an example now where you're looking at, first of all, we're looking at the S&P 500 index on long periods of time. So that's an extract from one of our papers published in the Journal of Portfolio Management, where we look at smart factor indices in equity markets. And so over these very long periods of time, we find that annual returns on S&P are about 12%, volatility about 17%, Sharpe ratio 0.41, max drawdown, well, doesn't look good, 54%. Well, that's probably 2008 that came along. Okay, what are we going to do now? Well, now we are going to select, we're going to split the universe in half, two halves. First of all, we're going to split the universe as a function of the size factor. We split apart the larger cap stocks and the smaller ones. Now, remember, we're talking about the S&P 500 stocks, so there are no small cap stocks in there, but they are mid cap stocks versus large cap stocks. Here is what we find. We find that the Sharpe ratio of the cap-weighted portfolios of the smaller stocks, of the 50% of the smaller stocks, is 0.59. It's better than the Sharpe ratio of the cap-weighted portfolio of all stocks. Now, why do we get a better Sharpe ratio? Are we getting a better Sharpe ratio because we are holding a better diversified portfolio? Well, no, I'm actually holding a less well-diversified portfolio because I'm splitting the universe in half and I'm only using 250 stocks. Plus, I'm cap weighting them, so I'm focusing on the biggest of them. Yes, but I've done that on a selection of the mid-cap stocks. So in other words, the reason why I get better performance, 300 basis points annual excess performance, plus, about the same volatility and better Sharpe ratio, it's simply because I'm now harvesting a piece of the size premium. And now if you look at the momentum factor, well, the same thing applies. I get a better Sharpe ratio compared to cap weighted. Same for the low vol factor, where I get a Sharpe ratio of 0.47. Sorry. And with the value factor as well, I get a Sharpe ratio of 0.48. And again, with an excess return of a few, well, more than 150 basis points in this case. Lesson number one, tilting the portfolio towards rewarded factors will lead to an improvement in risk-adjusted performance. Now, these portfolios are not smart; they're just factor tilted. If I now switch to a better weighting schemes, I get a further improvement. So as you can see, let's say for the size factor, I went from 0.41 Sharpe ratio for S&P 500 to 0.59 for cap-weighted mid-cap stocks. Now, smart-weighted mid-cap stocks, that's what I call diversified multi-strategy. It's a combination of smart weighting schemes. I get to 0.70. That's a huge improvement. And in all cases, as you can see, for all factors, whatever the factor, there's value in diversifying away unrewarded risk through the use of a better diversified weighting scheme. Okay, so conclusion at this stage, well, it's pretty simple. When you think about equity markets, it's not like there's only one premium, the equity risk premium. There are multiple premium. There's the equity risk premium, and then you get the size premium, the momentum premium, the value premium, potentially the low vol premium that sometimes we call the low vol anomaly for different reasons. And then you can have whatever, the investment premium, the profitability premium, the quality premium, as we call it, if we combine those two factors, and so on and so forth. And the new paradigm now is saying, well, as underlying building blocks, I don't want to be using the S&P 500 index. I want to be using a smart weighted portfolio of factor tilted securities. So now I get for the US 4 building blocks, at least. The smart size premium building blocks, the momentum premium building blocks, the low vol building blocks, and the value building block. And now I can do the same thing for, let's say, 5 regions in the world, say 5 regions of the world developed markets. And now I get 5 regions times 4. Well, these are my building blocks. So that's what we mean by factor investing. And the bottom line is, in equity markets, it has become extremely handy to organize, operational, inexpensive. And to make a long story short, some of the largest asset owners on the planet, including some with whom we work here at the EDHEC Risk Institute, well, they have massively shifted to the factor investing paradigm for cost and risk efficiency reasons. Okay, good. So now that's the first big step in this revolution, industrial revolution. Now, the good news is we have access to a set of building blocks which are smart in the sense of, well rewarded risk premia. So this is essentially risk premia made investable. That's what we mean by smart factor investing. It's risk premia made investable that I can use as a building block. Okay, what's the next step? Well, the next step is, how do you put the building blocks together in the first place? Is there a way to put the building blocks together that's better than another way? Well, this question has been revisited from the perspective of what we call goal-based investing, which is a novel paradigm for how to put building blocks together. And goal-based investing is extremely important because it goes in the direction of mass customization or full customization, depending on the context. So in other words, the answer to your question is not, if the question is there a better way to put the building blocks together? The answer is yes, but this better way is actually a function of the goals that you're trying to achieve. Well, that's exactly what we mean by goal-based investing. Okay, what is goal-based investing? Well, goal-based investing, again, the concept is extremely simple and compelling. It means if I'm talking to a client, if I'm looking at an individual client, I need to understand what are the goals of the client. Preparing for retirement, buying a piece of property, financing kids' education, whatever is the goal or the set of goals of the client. And then when I'm putting together an investment solution or investment portfolio for this client, I want to put together a portfolio that will have a good chance of maximizing the probability of achieving these otherwise extremely meaningful goals. That's what we mean. As opposed to, well, I put together a portfolio and that portfolio is a great portfolio for everyone. Well, no, there's no great portfolio for everyone. Portfolio should be customized with respect to people's needs, and different peoples have different needs. Now, this is true for individuals, but of course it's also true for institutions. And the goal-based investing concept is also known as liability-driven investing for individuals where for institutions where different institutions have slightly different liabilities. Different pension funds have different liabilities, and then you get insurance companies that also have different liabilities as well. And you want to customize, of course, the investment solution with respect to the particular needs of this institution. Now, let's remember something. What's the alternative to goal-based investing for putting together building blocks? I mean, the alternative is modern portfolio theory, Markowitz analysis, efficient frontier analysis. I mean, come on, that theory is 65 years old now. So it was okay to call it modern portfolio theory in 1952 when the paper got published by Harry Markowitz. And that was a great achievement. But we are now 60 years later, and if we're still using this old dated technology, Well, essentially, we are failing our clients. Our clients have goals, they have objectives, they have liabilities, and we need to do something extremely effective for addressing those needs. Well, again, it's called goal-based investing in individual money management, and that's about the same concept that we call liability-driven investment for institutions.
Lionel, I have a question also, all right? And this is coming from an individual. They say their job is investment products, right? And the question is and there's a shift to solutions. The question is almost, how do you see my job as an investment product person? How do you see it changing with this shift to goal-based or liability-driven investing and the shift to factor? How does my job change? Does the product job go away?
Okay, well, it all depends what exactly is your job. So if your job is to be an equity portfolio manager, well, your job is not going to go away because we always need an equity building block as part of these meaningful investment solutions. So I don't care what your goal is. Maybe you want to prepare for retirement, or maybe you want to prepare for financing kids' education, or you want to buy a piece of property or retire someplace, or your CalPERS, and you need your funding ratio to go back up to the place where you'll be able to pay those pensions to the retirees. In all of those cases, you need upside. And to generate upside, you need to be efficient at harvesting risk premium. So if your job is managing portfolios within a given asset class, well, your job is still going to be there, but yes, you're going to be facing increasing competition from smart factor indices. Okay? And if you look at CalPERS, for example, well, CalPERS is massively investing in smart factor portfolios, but I'm naming CalPERS, but most of the large institutions around the world are moving away from active managers based on security selection towards smart factor indices. So what's the new value added for equity managers now? Well, the real value add is to being able to say, well, the building blocks are available. And perhaps the world doesn't need me to produce or manufacture the building blocks. But the world definitely needs me to put together these building blocks so as to make sense for my clients. So I'm going to go talk to CalPERS, or I'm going to talk to individual clients, or I'm going to segment the market with my marketing team. And I'm going to say, well, for these types of needs, there are equity portfolios or equity factor exposures that are better suited than others. So yes, the job is not going away, but it's kind of shifting in terms of emphasis. Well, at least what we see clearly is a big flow of assets under management, of AUM, away from the traditional boutique doing active portfolio management with a small tracking error and security selection, stock picking. That's kind of slowly but surely vanishing away. And people are now getting into, well, factor-based kind of investment solutions. So you can add value in terms of tactically timing the factor exposures as opposed to picking the securities, if you will. These are very big evolutions. Now, when we talk to customization, we have two ways to think about it. If the client is a pension plan or a family office or even a high net worth individual, then we should be in a situation, or we should be in a position to design and implement a fully customized investment solution. Call it LDI for liability-driven investing or GBI for goal-based investing. But we should be in a situation of implementing a fully customized solution for this particular client. Now, for the smaller clients, and I'm talking about the retail, mass market, or even the mass affluent market, we don't have to do full customization. That would be very hard for smaller clients. But what we could do, and what we should do actually, is mass customized, right? So we can come up, for example, with a series of retirement solutions that will address the needs of people in retirement so much better than the available products like target date funds. And there are a lot of things that we can complain about target date funds, and we're going to take a look at some payoff of a target date fund type strategy. But the bottom line, to make a long story short, is a target date fund is a product. And some of them are good products, some of them are bad products. But even the good target date fund products, they are ill-suited to be used as retirement solutions. That's my problem. So the world should, well, not only should, but is evolving toward these investment solutions and away from products, good products, bad products. So let me, let me think a little bit about what are the key ingredients in goal-based investing. How can we tell? If someone shows up with a process, an investment process, how can we tell there's goal-based investing process as opposed to, well, this guy is just putting together a new product and he's going to claim it's a good product? Well, there are three key properties for meaningful investment solutions. Not more, so it's important to check them out. The first one, which is must-have, is we need a building block that's going to be safe. And that comes from a technology that we call hedging. Hedging is a form of risk management that allows us to be safe if and when we need to be safe. Well, let me give you an example. Let's say I'm 50 years old, and let's say I'm retiring in 15 years from now. So I'm 50, and I'm retiring at age 65. And I want to buy a safe asset for retirement purposes. Okay, well, if you buy a target date fund, what they call the safe building block of target date fund, it's a short duration bond portfolio. It's a bond portfolio with a 3-year duration. Well, that's not safe. What is a safe asset for someone preparing for retirement? Well, a safe asset for someone preparing for retirement is pretty simple. It's a bond portfolio which is going to pay no cash flows, zero, nothing, for 15 years. That's what I call a forward start portfolio, right? I don't need cash flow for 15 years because if anything, for the next 15 years, I'm still accumulating wealth. So I'm investing, I'm not withdrawing money, right? Now, I want that portfolio to start paying off cash flows starting when I retire for so many years in retirement, right? So what I'm talking about is essentially a forward start inflation-linked bond ladder. I don't want to receive coupon payment plus principal back at the end. No, I want a steady stream of cash flow. Well, ideally inflation-linked, because that's exactly matching my consumption needs. Well, let's call them replacement income cash flows, right? So when we reach retirement, we need replacement income. We're not working anymore. We don't get the same paycheck. We need replacement income dollars. So a safe asset is an asset, or a safe portfolio, or safe building block is a portfolio that's going to pay replacement income. That's what it is. Okay.
Lionel, I have two questions that have popped up. Just anything out right this second, but I have two questions. One kind of touches back a prior subject a tiny bit, right? And that question is this: how does one decide on what asset class to use to get desired factors? And you may not cover this entirely here. Obviously, this seminar covers more of this, but how do you do that just in concept?
Okay, well, very often there are practical limitations that, force us to turn to a given asset class. Okay, so depending on whom we're talking about, if we're talking about CalPERS, well, the place that they're going to look at predominantly is equity markets, simply because equity markets are extremely liquid, and that's where they're going to get the kind of capacity that they need. Now, if you're an individual, equity markets is also the place where you get all kinds of liquidity. Okay, so usual suspects are stocks and bonds. Now, if you're CalPERS, or if you're an individual and potentially a high net worth individual, it would be good for you to get exposure to factors above and beyond the kind of factors that you can find in long-only exposure to stock and bond markets. So you may want to turn to private equity, real estate, commodities, maybe hedge funds, and other forms of alternative investments. Infrastructure as well, especially if you're a large endowment or a pension plan, this is something that's going to give you a liquidity premium as well. So this is, by the way, something that definitely will be covered in some of these seminars that we're going to talk about, because there's a lot of emphasis on not only harvesting traditional equity and bond risk premium, but also harvesting more illiquid alternative risk premium as well.
Okay. Second question here now is actually a little broader. Is, well, how does the mass customization fit or play in the fixed income sector? So how, and where derivatives are not an option?
Okay. Well, in fixed income portfolio management, you can definitely use derivatives if needed, especially for large mandates to kind of customize a given set of interest rate exposure. Now, if we're talking about the retail space, okay, what we're talking about, we are talking about building blocks that are duration match bond portfolios. So in other words, if I retire in 15 years, and then I need the replacement income cash flows for, let's say, 20 years after I retire, leaving aside the problem of late life longevity risk that I can deal with through buying, late life annuities, for example. If I care about, the first 20 years in retirement and I'm 50 years old, well, that problem is different from a problem that is being faced for someone who's 55 years old, or someone who's 60 years old, or someone who's 65 years old. I need a longer duration portfolio, they need a shorter duration portfolios. Now, these kind of duration matched bond portfolios, well, they are bread and butter of income portfolio management in the institutional space. And on a daily basis, fixed income managers put together these building blocks for the pension funds of this world. And what kind of frustrating, and that's part of the industrial revolution and the mass customization, is that we as individuals, we don't get access to these building blocks, right? So if I want to buy replacement income today, well, if I turn to available products, nobody is going to give me a bond portfolio that's going to match the needs that I have in terms of replacement income. More often than not, I'm going to get too short kind of duration bond portfolios, which are extremely risky with respect to my replacement income needs. So there's a good reasons to believe that the technologies and the principles and the building blocks that have been used for a long time now, for the last 15 years, in institutional money management are now transferring to retail money management. And it's not like we need derivatives for that. It's okay, we can do it in a long-only bond format. That's definitely doable. Now, that's the first building block for goal-based investing strategy. The second building block is the one that cares about diversification. Well, it's the one that we've already talked about. It's the one that's going to give you upside, right? Because the safe building block is good because it's safe, but because it's safe, it's not going to give you upside. So if I'm extremely wealthy, it's okay, I'm going to buy this forward start inflation-linked bond ladder as much as I need to generate the kind of replacement income I need. And CalPERS is going to buy these duration match bond portfolios. And they are going to be using these duration match or cash flow match bond portfolios to pay pension payments. Well, the problem is CalPERS is underfunded. I might be underfunded as an individual. And collectively, we are underfunded. I mean, pension systems throughout the world are underfunded. I mean, the French pension system is severely underfunded, but that's the same for the UK, that's the same for the US, right? So we need upside, we need performance. Where does the performance come from? Well, the performance is going to come from this harvesting of risk premium. Now we are back to stage number one. We are back to the mass production of the smart building blocks. So clearly now we see that there's a picture emerging where we take a well-diversified portfolio of well-diversified risk premium. And we put that together and we put it along, we hold that portfolio along with a bond hedging portfolio, like a forward start inflation-linked bond ladder, if you will, of some sort. And this is now starting to look like an investment solution. Well, actually, you can do slightly better than this. You could have not a static allocation to the safe and the risky building blocks, but you could also have a dynamic allocation to the building blocks. Now, we are not going to spend too much time on the subtleties here. We don't have time tonight or today to talk about the subtleties of the benefits that you gain from having a dynamic allocation to the building blocks. But to make a long story short, with the dynamic allocation to the building block, you can get those payoffs that look very nice. So let me give you an example of what I call a nice payoff. Somebody shows up with a pot of retirement income money. And that's the money they've been saving for retirement. And the guys are still, let's say, 15 years away from retirement. And they want to know how to invest their money for the next 15 years. I'm saying, okay, let's look at how much replacement income you could buy today if you were to take all of that money and you were to buy those safe cash flow matching bond portfolios. Well, if you do that, you're going to get 100% of your purchasing power of your wealth. Now, the problem is typically 100% is not sufficient for you because you're underfunded. You'd like to have something like 130%. You'd like to have 30% more than what you have now. How do you get 30% more? Well, the only way for you to get 30% more is risk-taking. You've got to invest in risky assets like stocks and potentially alternatives. And that exposure to more risky assets will give you the upside potential that you need. Now, wait a minute. When I'm getting upside potential, I'm probably also being exposed to downside risk as well. Well, yes, you are. And actually, the smart factor indices, they do better than the cap-weighted indices on the long run. But in the worst market conditions, they are not going to do so well. If only, by the way, because if you're earning a premium, like the value premium, it's actually probably because value stocks are even more risky than the rest of the market. So you can't, at the same time, want to earn a premium and want to be kind of neutralize the risk exposure within the premium, right? That's why we have two building blocks. One, the must-have diversification risky building blocks that's good at harvesting risk premium. And then we get the first one, which is good at hedging. Now, here is what we're saying. We're saying that if somebody shows up and says, well, my goal is to get 30% more. So that's my target. I would like to go from 100 to 130% of my purchasing power in terms of replacement income. But I don't want to go below 80, because if I go below 80, then I'm going to be starving in retirement, right? So somebody shows up with 100% worth of purchasing power. Below 80% of that, they are starving. 100%, they're not starving, but they're not happy. 130%, they're happy because they give them the kind of consumption pattern that they seek in retirement. And now I'm thinking carefully about goal-based investing now. Well, here is where goal-based investing can help you. Goal-based investing is all about maximizing the probability to reach the target, well, 130 in this case, while securing the minimum, and the minimum being 80. Okay? So on the left-hand side, we look at an optimal strategy. That one is a little too good to be true. It has a very high probability for the client to reach the target. And whenever the client doesn't reach the target, then the client in the worst market conditions, in the worst scenarios, then the client is stuck at the minimum. Well, this is a little too good to be true because I'm assuming away transaction cost. I'm trading kind of continuously. There's leverage and potentially high leverage. So I'm now turning towards an implementable strategy. That one is very easy to implement: quarterly trading, couple of building blocks, the fixed income building blocks, and an equity building blocks, just to keep it simple. Now, that strategy, I like it a lot because it has a high probability to be around my target, which is 130. Sometimes I actually even get a little better. And that's in the good scenarios or in the okay scenarios. Now, in the very bad scenarios, my risk-taking doesn't pay off. But because I'm hedging and I'm dynamically hedging, in the worst possible scenarios, I'm limiting the loss to 20% of my current purchasing power. Okay, so that's what I mean by goal-based investing payoff, where the probability is concentrated to where it matters for you. And because you said, as a client, 130 is my target, well, the bulk of the probability is at 130. Now, in contrast, if now, in contrast, you start using, if in contrast, you start using products, here is what you're going to get. Well, that's an equity products, that's a bond products, that's a balanced fund, which is 50% equity, 50% bond, and that's a target date fund, which people use for retirement. Now, I don't like what I'm seeing here. The reason why I don't like it, it's because these are products and these payoff have no shape. The client said, I want 130. Well, 130 is somewhere here, but nothing happens. You can get better than 130, you can get less than 130, all shapeless. Now, what's worse is there's actually a very high chance that you get worse than 80. Okay, and by the way, even with 100% in bonds, which people sell as a safe strategy, because you're not using the right kind of bonds, because these bonds are not duration matched, well, there's actually a very high chance that you end up below the minimum, which is very bad. The target date funds, well, they don't do anything good. So those distributions are products distributions. They don't do justice to your goals. These distributions, this one is a goal-based type distribution where the payoff is concentrated around the objectives of the client.
Lionel, that was excellent. There's 5 minutes left, right? I actually have 3 questions, right? But also we need some time to also recap the certificate program and explain that to the audience too, right? So the 3 questions, go quickly through them. The first one is around how do you quantify behavior inclination and bias forming in portfolios? I'm not sure if you can answer that or not, that question there, but looking for behavior inclination and bias as opposed to factors.
Okay. There are 2 ways to think about behavioral biases. One way to think about them is you can actually make money out of that because the behavioral biases of the collection of individuals will lead to some stocks having a higher returns than other stocks. Maybe because everyone is rushing towards the glamour stocks or the popular stocks that drive their prices up and their expected returns down. So one way to think about it is, well, because I know about it, I'm going to actually tilt my portfolio away from these guys so as to earn a higher premium. That's one way to think about it. Another way to think about it, that's in the context of the building blocks. That's the way to go. Now, in the context of mass customized, well, if your client tells you something about their behavioral biases, and if you don't like them, if you think they are irrational, well, that's not your problem. That's your client's problem, right? So what you can do is you can still customize a portfolio that will do justice to the needs or the expectations of your client. And if your clients have behavioral biases and they're happy to live and die with them sometimes, well, you know, after all, you can try and convince them that this is a mistake, but in the end of the day, they are in the driving seat, right? So they should tell you what exactly they need. Okay.
Next question. Is that maybe a little misunderstanding here? It says, are you recommending portfolio insurance as the core of goal-based investing?
No, I'm not. And that's why I was distinguishing between the must-have and the nice-to-have. So what I'm saying is portfolio insurance, some kind of portfolio insurance is needed if you want to secure a minimum with probability 1. Now, if you don't care about securing a minimum with probability 1, you can do goal-based investing, not do insurance at all, and have the 2 meaningful building blocks, the performance-seeking risky building blocks and the safe hedging building blocks. So depending on the context, portfolio insurance can be useful. In other contexts, it's either not implementable or sometimes too costly, and therefore you can do without it.
Okay, the final question before you recap or before you summarize the seminar and the certificate program. Given your comments on underfunded government pension systems, how do you incorporate the implicit credit risk that comes with owning inflation linkers or any other hedge?
Well, if we are thinking about treasuries as having credit risk, yes, that's a fact of life. Corporate bonds are risky, but we've learned the hard lesson through all of those crises that even sovereign bonds can have some credit risk. One way to think about it is, well, at least I'm earning a little bit of premium. So if I'm holding, you know, France as opposed to holding Germany, there's a little bit of spread, not much, but because there's a slightly higher chance of default. Hopefully not too big from the French treasuries compared to the German treasuries. Okay. Well, let's put it this way. These guys are the closest approximation to the risk-free asset that we have. They're not entirely risk-free, but, you know, it's kind of hedging market risk away, not necessarily hedging credit risk away.
All right. Can you now take the time, Lionel, to summarize now the certificate seminar? This was a kind of teaser, a little taster for what we do, but then go explain kind of deeper kind of the seminar itself and also the certificate program itself.
Sure. So, I mean, the program that we've put together with our colleagues at the Yale School of Management is a program that has the ambition to equip participants with the latest conceptual understanding of what are the needed ingredients in the design of modern forms of investment solutions. In other words, we've put together a series of 3 seminars. Each one of these seminars is a 3-day seminar where the seminar number 1 is called Multi-Asset Investment Products and Solutions. That's the seminar in which I'm personally involved as an instructor for 2 days. And my colleague James from the Yale School of Management is involved in the 2nd day. So what we do in this seminar is we talk about factor investing and risk allocation across asset classes. So switching from asset allocation to factor allocation decisions. And then we move on to talking about life cycle investing, goal-based investing, and thinking about all of those questions like preparing for retirement, better forms of target date funds, better forms of investment solutions. James steps up after these first 2 days, and he's going to talk about how you can spice up and further improve all of these meaningful retirement or otherwise investment solutions by adding some components of predictability in assets and factor returns. So if you are in the context of designing a multi-asset products, forget even about the solution, it's a multi-asset products, well, then you're going to be happy to leverage on predictability in stock and bond markets, if you will, to kind of improve the performance of your multi-asset product. And that's exactly what James is going to talk about. Then seminar number 2 will be dedicated to equity and bonds, harvesting risk premia in equity markets and bond markets. My colleague Ramanupal will focus on equity, followed by Will Gottsman on smart beta and factor investing in the equity space, and both of them have extensive experience on those subjects. Will have been working with a Norwegian pension plan on thinking about harvesting risk premia. There's a lot of expertise, both from an academic standpoint and also practical standpoint. And my colleague Ricardo Rebonato, who used to be head of fixed income research at PIMCO, is going to talk about harvesting risk premia in fixed income markets. And again, a lot of academic expertise with a very strong kind of practical feel from Ricardo as well. Seminar number 3, turning to alternatives. Will Gottsman again, talking about the Yale models and the Yale model and how to invest in private equity, hedge funds, real estate, and fine art to kind of seek out risk premia across and beyond bond market. And then there's going to be a dedicated focus on 2 alternative classes that are of importance. Gert Rovenhorst is going to talk about the fundamentals of commodity investing, and Frédéric Blambreux d'Osseiling, a research institute on infrastructure investing, is going to talk about infra and the fundamentals of infrastructure investing.
All right. Thank you, Lionel. You will all be receiving an email that will outline basically the first seminar, and then also the overall certificate program, and then we'll also direct you to the link, the website for signing up and register for the programs. Today was really kind of giving you a sense of what those seminars are like, the flavor and the level of depth, and also the applicability to you as a portfolio manager, as a fund manager, as an endowment manager, something that really would be valuable to you as you move to more advanced techniques in the industry. And then enhance yourself also with both a certificate from the Yale School of Management and also from the EDHEC Risk Institute. So thank you for attending, and we look forward to seeing you at the seminar in New Haven. Thank you. This concludes the seminar.
Thank you.